the same as we did yesterday and the same as we'll do tomorrow. Because a high probability trade is defined when each indicator on every chart agrees with the rules for the trade. So if you're brand new in my room, and I know that we've got some new folks in here, understand that while there's a lot you can do with the software, there's so much opportunity. You're probably going to see a lot of it today. For the brand new user, we break it down to only one trade. And I spent an entire hour going through this. We talk about a high probability trade, specifically a high probability trend trade. Everything is going to agree. And this is a trade that when you learn the rules, learn how to follow them, this is a trade that typically wins 70 to 80% of the time. And there is an extraordinary level of confidence that comes through that memory of success. And the best thing about the high probability trend trade, and this is my goal for you guys every morning, is that it teaches you to read your indicators. It teaches you to become a chart reader, which means that you're going to be able to look at your charts and say to yourself out loud, scare the dog. I have this advantage and that advantage, and I don't have this advantage, and my rules are met or my rules are not met. And that's all you're going to do. 90% of your day is going to be reading your charts. You can't see your stop loss. So in order to see your stop loss, organic, and your profit target, you have to actually be in the trade. So what happens, and let me show you exactly what I mean. There we go. So if I put a limit order in, you're thinking, man, I can't see my profit targets. I can't see my stop loss, right? Well, until you're actually in the market, you don't need them because you're not in it. But what happens is, let me just, what is this, crude oil? What happens though is once you get into the market, once that order is activated, both your stops and your targets will show up for you. So you just have to be in that position. That's pretty common. I did that too. I was like, where the heck are my stops and targets? And that's exactly what it is. Until you're actually in the position, you're not going to see them. Great question though, because there's always 10 people wondering. I appreciate that you would drop that in the room for everybody. So we're going to talk about this trade, guys. This trade that's going to teach you to read your indicators. You're welcome. This trade that typically wins more than it loses, and it's been proven to win more than it loses, and you're going to be able to prove that it wins more than it loses. And the sole purpose of teaching this one first is not to keep you from what there is coming, but rather getting that chart reading in place. Because if you spend 6 hours in front of your computer today looking for entries, you might actually trade 36 minutes of it. That's that 10% versus the 90% of waiting. But once you can read your indicators, and this is a lot of fun, you're going to understand some pretty vital elements, guys. You're going to understand where the market is likely to continue. These continuation points, these are your entries for the highest probability trend trades, maybe for your momentum trades, your HVA trades. Initially, it's just for the trend trade. You'll understand where the market is likely to go. This is going to allow you to make good decisions on profit taking. And you'll understand where the market is likely to stop. And that'll do the same thing. Not only will it give you an awesome spot to be able to take profits that you'll see long before the market gets to them, but it's going to let you know when you shouldn't take that next trade, when the trend may be ending, when it has the potential to reverse, when there's key areas that could create bounces that could affect your good time. You'll get all of this, and you'll get all of this just from the high probability trend trade. And then in the idea of simplicity, and new users, please take heed. It's only 3 rules. Allow it to only be 3 rules when you're new. Keep it this simple. Keep it as basic. And I'm not a black and white guy, but keep it as black and white as you possibly can in the beginning. These 3 rules for the highest probability trend trade that we teach, when true, create an advantage. So we don't say that a trade is the market going up, or a trade is I need to pay rent, but guys, rather a trade is 3 advantages produced by 3 rules being true. So a trade is momentum from strong triggers, and a trade is a clear path by no termination conditions in the way, none of those likely to stop areas, and it's defining an entry point where where the market is most likely to continue in the direction of these two advantages. This third rule is specific to the high probability trend trade. This is your entry rule. But once you understand the first two rules, once you can identify momentum through strong triggers, once you can identify a clear path by no termination conditions, you will have everything that you need to be successful with this software. You'll have everything you need to create a consistent, profitable plan. So I encourage you, in the beginning, don't worry about looking for trades. Worry about looking for advantages. Learn how to speak these out loud when they're true, and learn to be confident in what you're looking at. And that's kind of how I'm going to teach, is we're going to break them down individually. These three rules come to be, I don't know, Tony. I haven't heard anything about it. My wife asked me yesterday, and I didn't have an answer. But let me go to the boss real quick. There we go. I just dropped it into the boss. So we'll see if he answers. I still haven't updated mine. John said yes. Thanks, Rob. There we go. So those three rules for the high probability trend trade, guys, they come to be on only two charts. That's it, two charts. And I'm going to tell you again, there's a multitude of charts that you can print out, that you can bring up. You could do range charts, minute charts, tick charts. You can do big charts, little charts, super big charts. But I'm going to be honest with you. The easiest way to get to where you want to be is let it be three rules on only two charts. Use a large chart and a small chart. Your large chart, the most current bar right there, is all I need on this bar, or on this chart, to be able to define the direction of the market that I should be looking for my rules to be met, to define that advantage of momentum through rule number 1, and also to make sure that I have a clear path via rule number 2. 66% of your rules, 2/3 of your advantages come from the large chart. And then write this down. Only when the rules are met on the large chart, this broad stroke of a brush showing the overall opinion of the market, only when the first two rules are met will I turn my attention to a smaller chart. And the smaller chart's a faster chart. And it gives an X-ray, if you will. An X-ray, and yeah, I've verified yes on the update. Rob, it's not that I didn't believe you, but John Novak believes you too. Your small chart is a refinement chart. It takes an X-ray of that one bar on the large chart, and that X-ray inside of this one bar is an entire pullback and continuation of the trend very often. And all of this small chart happens in just one bar. So when the large chart has momentum, when the large chart has a clear path, you'll be able to see all this movement on the small chart to be able to pinpoint your area for entry, to take that best of the best entry. And that's what allows you to reduce your risk. That's what allows you to maximize your profit potential. So rule number 3 is for entry, and rule number 3 is specific to the high probability trend trade. And there's just no reason to even look at this chart until the first two rules are met. So we use these two charts. My favorite analogy in the world is asking yourself, who are you trading with or against? I guess this is a metaphor. Trading with the large crowd, the men and women with enough money and influence to create trends, to establish momentum, the same group of people that are reacting at these key areas that you see long before you get to them. This is the large crowd. They're going to define direction, momentum, and areas. The large crowd is the giant machine that you never want to fight. Going with the large crowd is the easiest thing to do. Hey, good morning, Erla. But there is a small crowd. Large crowd sets the pace, gives the overall opinion. Small crowd fights the large crowd. It's just what they do. They can't help it. And they create retracements. They create that movement that you see on the smaller, faster chart. This retracement, when created by the small crowd, typically fails 70 to 80% of the time, which means when you can pinpoint your entries with rule number 3, you're literally getting into the market where their failure point is most imminent. And if they're losing 70 to 80% of the time, that gives you the potential to win 70 to 80% of the time, guys. So this refinement process is nothing more than hoping a group of people with a lot of money creates a retracement, and then you'll be able to define precisely where their retracement is most likely to fail, where the market is most likely to continue in the direction of the trend. So for my brand new users, once again, we're going to learn the trigger line and the Fibonacci rules for when it's okay to trade. I will break down each rule individually because a trade is each rule combined. So when we talk about the rules, you're going to see one rule at a time. We're not going to talk about its connection to another rule until we get into entries. You're going to be taught how to study it. You're going to be given all the tools you need to study it. You're going to be given the tools you need to be able to take pictures, to make sure that you're studying it properly. You guys can simulate, especially. So organic, I know that you're just starting, right? But you've been in my class for a while. You should be simulating. You should be simulating and practicing and trying to follow these rules. And then the first step to getting to where you want to be ASAP is show me what you're doing. Post your trades in class, ladies and gentlemen. And every time you post a trade in my room, I'll talk about these 3 rules and how I see them on your chart, but I'm going to compare it to how you saw it on your chart. So don't just take pictures. It's really important that you annotate those pictures as well. And everybody in this room, if you have software, you have TechSmith Capture. So go find it in your search bar and open that up for me. I want to make sure that you can take pictures. It's a very easy tool to use. We're going to do a lesson real quick. It's a big red button that says capture. It really can't get much easier than that. So I'm going to right click or left click on that big button. And guys, it's a click and drag tool. So since we use 2 charts, it's important that you take a picture of both charts. So go from the left side of the chart, top left, to the bottom right. Release your mouse and click that picture. And what it does is it gives you a picture. Pretty easy. Up top are tools. There's arrows. You're going to use arrows, click and drag again, left click, drag it out as long as it needs to be, as short as it needs to be. But point it at your trigger lens and talk about momentum. Point it to whether or not you have a clear path. Show me your entry. Show me your exit. You can even use boxes if you want. You can talk about where your entry came from. You can talk about where your targets were. And use the call out button. So left click and drag down. This is your call out button. And guys, this is how I give you my 2 cents on everything that you're doing. You do me the honor of telling me what you saw, where you entered, why you entered, where you got out, why you got out. And if you give me that information, every time you post a trade in the classroom, guys, it's a private session. It's you and I, and it's just the 2 of us, you and me, sitting in the room, and I'm talking about your chart reads and making sure that it's accurate. And I'm talking about your entries and making sure it has the least amount of risk. And I'm talking about your exits. Could you have held longer? Did you hold too long? And I will give you everything rattling around in my brain to help you get better with this software. So once you annotate it, once you do all that, just click the copy button. And it'll copy it to your clipboard. Come over to the chat box and drop it in. Show me that picture, and then I'm going to open it up and we're going to have a discussion. So simulate, post in the room. The people that post the most get to where they want to be the fastest. It's just the truth. Simplify your trades. Simplify your 2 trades in your plan. I'm going to hand you a plan. That's part of what I do each and every day that gets you into the highest probability trend trade in a fashion that optimizes your chances of success. Once you understand that trade, it begins to open the door for more trades. And I give you a second trade as well. But the second trade is very dependent on your ability to understand the first trade. So let's focus on just one trade. What are the looks you'll commit to? The looks you're going to commit to is the pattern that's been proven to win more than it loses. And that's what we're going to talk about for an entire hour. You've got to learn those patterns. You've got to learn those looks so that they become easy. That's the second half of getting to where you want to be ASAP. Nexgen gives you a spreadsheet when you download the software. It's in your Nexgen Study Picks folder. I drop it in the room every day because every day I seem to add to my spreadsheet. You should too. The first tab on the spreadsheet, this is your trade journal. So every time you take a trade, this is where it goes. So Cav dropped a trade in the room. Cav is going to take this trade, win, lose, or draw, and he's going to go to a spreadsheet and he's going to drop it in here. And what he's going to do is he's going to come back tomorrow and he's going to look at everything that he did yesterday or everything that he's done today. And he's going to say, what did I do? What were my advantages? And they're written out on the chart as well. Cav does a great job annotating. And he's going to go, man, was there any feedback from class on my picture? Was it, hey, Cav, this is beautiful. Don't ever miss this trade. It fits all your rules. Or maybe it was trading in determination conditions. Whether it won or lost, trading in determination conditions, long term, is a path for failure. And when you start to see the same feedback, what you've done is you've recognized your thing that is bringing you success, or your thing that's taking it from you. And when you see your mistakes and you go back and you say, oh my gosh, I keep trading into areas that can stop the market, you get to wake up the next morning focused on avoiding those termination conditions. And if you give me 4 or 5 pictures in the room, I'm going to be able to recognize your thing, and I'm going to give you a plan to identify it, to avoid it, and how to overcome any challenges that you're having so that you can get to where you want to be. The second tab is the basic rules. And the basic rules are just that. They are the core rules, the foundation, those high probability trade rules. What it looks like to have them true is in green: strong triggers, clear path, and entries. And I've done a lot of work on this spreadsheet, but I'm also going to give you a piece of paper that teaches you how to do your own work to get these concepts down. But a trade is column A plus column B plus column E, and that's what it takes to get you in the market. If you only have column A but you don't have the rest, you don't have a trade. Your rules aren't met. So it shows you what it looks like to have strong triggers, and then it's important that you understand what it looks like to have weak triggers, the opposite of strong. It talks about a clear path, and it shows you what it looks like when you shouldn't be trading into that line. So learning both sides of the coin so that you can commit to only entering the market when the rules are true. That's what we're going to do today. We're going to talk about these rules. We're going to break them down individually. I'm going to show you how to study them. I'm going to try to beat the dead horse, telling you that the easiest way to get to where you want to be isn't taking trades over and over and over in the first week, but rather taking pictures over and over and over in the first week. And guys, this is one picture of crude oil. And in one picture of crude oil, I've got 1, 2, 3, 4, 5, 6 pictures of termination conditions, reminding me that I'm not in control, but I do know where the market is likely to stop. I've got pictures of strong triggers. I've got pictures of weak triggers. I got pictures of broken areas. Guys, this is one picture in 3 minutes of my life, and I can stare at it and I can begin to see things that are going to help me. I like to show this. My trade count is right under 8,500 right now. My previous Snagit has over 12,000 on it. I'm over 20,000 pictures, guys. Pictures are what are going to get you to where you want to be. And then more importantly, feedback on those pictures is going to set you up. So it's scary to post in the room, and you don't want to be wrong. Guys, I want you to be wrong as a new user when you're on simulator, when you're not risking your money. I want to see how you're reading your indicators and make sure that you're reading them properly. One of the biggest things that tends to happen to Nexgen users, new users, is you sit in my class and you listen to my rules, but you never ask for feedback. You never show me what you see. And then you go off and you start trading and you misunderstand a lesson. Just even if it's by a fraction of a hair, that misunderstanding, creating your own truth on what it means to have a rule met, can be detrimental. And if you just show it to me, we can fix it instantly. So we're going to talk about the indicators real quick. What am I looking at every time I open up a chart? Because this is the language I'm going to use, and I want you guys to know what I'm talking about when I say it. On every chart, there are small triggers and large triggers, and they're the same no matter what time frame. Small triggers are always two solid lines working together to create the small triggers. They're just a fast moving average. And then large triggers are always two dashed lines working together to create the large trigger. And they're a slow moving average. And that's about as technical as you need to be able to use them. Initially, we're going to use them to define momentum. Rule number one is nothing more than trigger lines. You don't need fibs. You don't need areas. Hell, you don't even know what the trend is. But trigger lines define momentum first. And then you're also going to see areas. And areas are amazing. Areas are just the lines on your large chart. That's it. Lines on your small chart, lines on your range chart. Doesn't matter what kind of chart it is. You're going to see areas. So we're going to give them a name. Divergence highs are magenta lines. And they'll come off the top of a pivot if there's a loss of momentum. So every time you hear divergence line, I want you to think loss of momentum. Divergence is a loss of momentum. If it comes from a low pivot, it'll be blue, cyan, light blue. You're going to see Fibonacci resistance on every chart. And when the market is going up, resistance can create a bounce down. That's the easiest way to think about it. You're going to see blue Fibonacci support. And when the market is going down, blue Fibonacci support can create a bounce up. You're going to see yellow 1-to-1s. If the market's going up, it acts as resistance. If the market's going down, it can behave as support. And you're going to see a mid band running right through the middle, guys. And this is just a EMA. And it just kind of shows that middle moving average. So these are what you're going to be looking at each and every day. And I will give you this PowerPoint. So you'll have access to all these pictures that I'm using to teach the class. But we're gonna start and we're gonna break it down. And we're gonna look at each rule individually. And I'm pretty good at this. So every now and then I'm gonna ask you guys, hey, does that make sense? Are you following me? Do me a favor. Anytime I ask, hey, are you guys good? Either give me a Y or an N. And if it's a Y, I'm just going to move on to the next rule. But if it's an N, we're going to back up a little bit and we're going to say it a different way. And we're going to make sure that nobody gets left behind in this classroom. That's my goal. So large chart leads the way, guys. The large chart is going to define direction. The large chart is going to define momentum through rule number one. And the large chart is going to identify the areas that are impactful through rule number two. So we're just going to focus on rule number one. We're not worrying about a trade. We're worrying about advantages. And the first thing you got to do when you look at a large chart is you got to say to yourself, am I looking for rules to be met to go up or to go down? And the color of the large chart behind that first bar will let you know exactly which direction you're looking for rules to be met. If the background is green, we're going up, looking for rules to be met for high probability trend trades long. If the background is red, it's going down. We're looking for rules to be met for high probability trend trade short. The trend is your friend. I'm not sure if you've ever heard that. So in an uptrend, the only way to have strong triggers is if your small triggers and your large triggers are both green as well. That's kind of your little cheat. As long as the colors match, you at least have the potential for strong triggers. But what strong triggers is, how it's defined, and it's defined this way on any chart that you own. Your small triggers must be up and above the large triggers. There needs to be space between the small and large. The large must be up as well in green. And then I love to draw, and I want you guys to see this. Strong triggers, they look like scissors that are open. Strong triggers look like open scissors. And when scissors are open, you can clamp down and cut. You can get work done. So in a downtrend, it's the same thing. Small's below the large, large or wide, space between the two. All of the colors match. And I just want you to associate the space between the small and large means strength. And when I have space between small and large, whether it's up or down, the odds are favorable for the market to continue in the direction of the trend. And you're going to hear odds favorable momentum in this room all day long. You're going to see OFM tattooed on charts when people are recognizing and identifying that advantage. So odds favorable momentum can push a market. Odds favorable momentum can break key areas. Odds favorable momentum can cover mistakes that we're all likely to make as new users. And when my triggers are strong, that's when we're going to start looking for entries. That's when we're going to look for that second rule. Day trading is a flow chart. If I have strong triggers, then I'll go to rule number 2. And the opposite of strong is weak. And I like to show both sides of it. When those small triggers come back to the large triggers, when they work their way inside of the large triggers, this is when anything can happen up or down. You're going to hear that in class as well. What did your momentum look like? Well, my triggers told me that anything could happen up or down. That doesn't feel like an advantage. That doesn't feel like a scenario where I want to risk my hard-earned money. So you could either have it where the odds are favorable for the market to continue down, or you could say to yourself, anything could happen. Who knows, right? So the words that you associate with the looks are really going to pay dividends. And I want you to say that when you look at your chart. I have odds favorable momentum. I have weak triggers. And let me find my large chart real quick. And let's see what the most current bar is telling us. My smalls are below the large. The scissors are open. The space is amazing. Can you give me a Y in the room if you see it? On the most current bar in crude oil, I do in fact have odds favorable momentum. I do have rule number 1 met. Is everybody good? This is one of the most important lessons you're ever going to learn. Awesome. L, you don't even have to be a fly on the wall. Participate, man. Ask 1,000 questions. This class is for you. So that's rule number 1. And it really is. It's pretty easy to recognize there. So when I have that separation all the way until those small triggers return, guys, this is where I'm looking for high probability trend trades. And every now and then, price is going to go below the midpoint of the bar. Oh, I got you. Other work. Ugh, 4-letter word, man. Every now and then, price is going to go below the midpoint of all those bars going up, and it creates a tail or a wick. Guys, the bottom of these tails or wicks are potential entries. These are possible long trades with all that momentum. You're going to learn to study these tails, to go back and look at them. This is how you're going to really prove that the methodology is solid with a little bit of back testing. So anytime you see a tail, I want you to think, hey, that might have been an entry. And same thing when it's going down. The point of separation, all the way to the point of the return, you guys are going to be able to find opportunities. You're going to be able to find those entries for the highest probability trend trades. Not everyone will be an entry, but very often this is a great way to go back to study, to look at the patterns. So momentum's good, right? 2 of you said yes, that's awesome. 25 of you are confused but don't want to tell me. That's okay. Once I have momentum, guys, I have to make sure I have a clear path. What does that mean? If I'm walking down the road and something's in my way, I can't walk through it. I don't have a clear path. So trading is no different. If you have momentum, if that market is screaming in the direction of the trend, we want to make sure that there's nothing in the way, no termination conditions, which means I'm going to have room to my profit targets, which even better, we're just going to call it a clear path. And a clear path gives me that room to the profit targets. So what is a termination condition? It's a horizontal line on your large chart. How easy is that? It's that Fibonacci support or resistance. It's those yellow 1-to-1s. It's those divergence highs and lows, guys. These are all horizontal lines on your large chart. Do you remember the picture? That's it. Just horizontal lines on your large chart that may reverse the trend, that may reverse the market, that could create an untradeable bounce. That is precisely where the large crowd is most likely to make a decision. And it's based on a comparison of that area and the T3 trigger lines. So the same trigger lines that establish momentum are going to let you know whether or not you have a termination condition. And if the large crowd reacts at these areas, if the large crowd makes decisions at support or resistance, and you say that to yourself and you understand that concept, it makes it easy to identify them as termination conditions. So the first step, it's a 2-part process. The first step is price reaches resistance. The market is trending up. I've got nothing but green bars. Everything says up. And then price reaches Fibonacci resistance. And I instantly say to myself, oh my gosh, this is where the buyers might exit their position. This is where the sellers might try to take over a position. Heck, this is where the two might fight for a while. And the reality is I never know what the reaction is going to be. But if price reaches resistance and my trigger lines, ask yourself, where are my triggers? If they remain below Fibonacci resistance is a termination condition. Anytime I have a termination condition, rule number 2 is not met. And I don't take trades into that area. My rules say no trades into that area. So when it reaches and the triggers are below, there could be an untradeable bounce. It might break. There could be a fight that literally dissects this fib for the next hour as the two forces fight. Or it could even reverse the market completely. And that means that those large triggers, those slow triggers, the dash triggers, they pinch and roll from green to red. And if a termination condition, not a fib, but a termination condition reverses the market, guys, this is what we call a strong top. And a strong top is rule number 1 for about 3 different trades. And a strong top, while not mandatory, is the precursor for the highest probability trend trade that you could ever take. So here we actually do get that strong top. And that strong top creates odds favorable momentum. And that odds favorable momentum has nothing in the way until it hits Fibonacci support. And once it hits support, once price reaches the area, we are done with price. Whether price goes through it 10 ticks, 20 ticks, doesn't matter. Once price reaches that area, you have to ask yourself, where are my triggers? And if the triggers remain above, it's a termination condition. And your rules say no trades into that area. It may bounce, it may break, it could create a fight. If it reverses the market completely, we're going to call it a strong bottom. And that strong bottom is the precursor to the highest probability trend trade. It's not even one of the rules. It just creates a lot of warm fuzzies. So is everybody good with that very basic lesson? Price reaches an area. If the triggers remain below resistance, no trades into the area. Wait for the reaction. If price reaches Fibonacci support, trigger lines are above the area. No trades into the area. Wait for the reaction. Why do we talk about termination conditions? Because when price reaches an area, decisions are made. And guys, there's, oh my gosh, from support to resistance to support to resistance, big untradeable bounce to support, right to resistance. There's the reversal in odds favorable momentum coming into these areas. And guys, that's a snippet. That's a little 5-hour scenario in one market showing you how powerful these lines can be. If you go back and study these, you'll see it for yourself. But they do break. If they didn't, we'd be caught in a range forever. So we're going to go through what it looks like to break an area. And what it does is it gives you the first scenario. Every time you reach an area, guys, it's going to be a termination condition, even if it's only for like a minute or 30 seconds. But price reaches and the triggers are below, absolutely no trades into that area. Wait for the reaction. It's either going to hold or it's going to break. You'll never know. If the smalls absolutely smash through, your small triggers get up and above 2 to 3 points above that area of resistance, but your large triggers are lagging behind and they haven't made it above yet. 50% of your triggers are through, 50% of your triggers are not. As long as you have momentum, as long as you have strong triggers, this Fibonacci resistance has the potential to break. And potential doesn't mean that rule number 2 is met. Potential means that it might and it might not. And there's opportunity in the potential to break, but they have to be managed assertively. And this is the second trait on your plan, is being able to capitalize on the potential to break. But once the small triggers and the large triggers get above resistance, resistance is broken. Your path is clear. Resistance behaves as support, and your path remains clear until you reach the next area. And once you reach the next line on your large chart, the process starts over back to number 1. Same thing in a downtrend. Price goes down, hits Fibonacci support. Where are my triggers? They're all above, even if it's just for an instant. And I have to do absolutely nothing and wait for the reaction. Once the small smash through, 50%, and the large have not, 50%, 50-50 trade, this area has the potential to break as long as I have momentum, but it's not broken until the small and large get below, at which point Fibonacci support behaves as resistance. And my path remains clear until I reach the next area. Good morning, Miss Jen. So let's go back and let's look at that large chart again. Absolutely no trades keeps me out of the losers. With all that momentum, Fibonacci resistance breaks, triggers get above, it behaves as support, but it goes right into Fibonacci resistance. Even with odds favorable momentum, Fibonacci resistance creates a big, ugly, untradeable bounce. Here the small triggers got through, but the large triggers did not. That potential held true right until it hit a fib. Sure enough, the market reverses. There's one of those potential to break again. And guys, look at that. There's one of those tails. We're going to circle that tail. We're going to come back and look at this in just a little bit. But that's kind of a life cycle. Right now, this divergence low has the potential to break, but it's not broken yet because the triggers haven't gone through. And I want you to see how that works out in real life, and we'll get a couple scenarios. There was the potential to break, but it didn't. It's nothing more than potential. There was the potential to break, and it retraced really big. Potential to break, but did not. I like showing the potential because you're going to have a lot of them. Wow, the market just kept stopping right on areas. You guys are so lucky to have these areas. Look at that. Bing, bang, boom. But you're going to see these scenarios all day long. Potential, potential, broken, termination. You've got to commit them to memory. What it means and let the words, price reached an area, where are my triggers? Let those rattle in your head. It's going to keep you out of a lot of trouble. There will be times when your path isn't clear because the areas are stacked a bit. But before I get into this, is everybody okay on termination conditions? Price reaches an area, then we're done with price. Where are my triggers? Let the triggers define whether it's a termination, has the potential, or is actually broken. It's important. Once you learn that lesson, once you couple it with momentum, guys, you're off to the races. There will be times when your path isn't clear because the areas are stacked a bit. There will be times where you can't seem to find a clear path, where you can't even find one of those potential to breaks because all these lines are in the way. Guys, that's okay. This is 90% of your day. 90% of your day is doing nothing, and I want you to believe that it's okay to do nothing because the futures markets trades billions of dollars every day, and it's not necessary to be in every move. If you can capture $400 a day, that is a six-figure income based on your trading. And I don't care if this is day one, you're going to see the potential for that before you walk out of this room. And you're going to have everything you need to capture that before you walk out of this room. You just have to learn the process. So it's okay to sit on your hands, guys. If I don't have momentum, I don't look for my next rule. I sit on my hands and do nothing and wait for momentum because I'm never going to sacrifice the most important, the first thing that I look for in a trade. But if I have momentum, here comes that flow chart scenario, then I'll look for termination conditions. And then if I have a termination condition, I don't look for the trade. I'm done. That's it. I need my rules met. But if I have no termination conditions, if I do have that clear path and I have it with momentum, guys, I'm going to my small chart and I'm looking for an entry. I'm going to take advantage of these advantages. I'm going to enter the market. I'm looking for my 10%. If I go to that small chart, there is one time where the small chart behaves as a termination condition. And man, I'm going to say it one more time. There is one time where the small chart behaves as a termination condition and I won't look for the entry. And that is 3 divergences in the same price range. 3 losses of momentum, cyan lines from a low, magenta lines from a high. 3 divergences in the same price range may terminate the trend. What you're seeing when you see 3 divergences on that small chart is your small chart alerting you to the change that you can't see on that big, slow-moving large chart. And these 3 can stop it in its tracks. And it becomes more powerful with weak triggers, smalls inside of the large. And it becomes even more powerful if that final pivot is higher than the previous from a low, lower than the previous from a high. So On its own, 3 can kill it. I won't take that high probability trend trade. Weak triggers makes it more powerful. Head and shoulders makes it more powerful still. This look is the only time that my small chart is allowed to talk me out of a high probability trend trade. If one divergence prints, I'm taking the trade. If one divergence prints and maybe there's a 1-to-1 or a fib somewhere nearby, I'm taking the trade. It takes 3 divergences to keep me out. So if I have momentum and I have a clear path, I don't have those 3 divergences. Guys, I'm looking for an entry. This is where the precision comes in. This is where you become stuff of legend with your amazing entries. Rule number 3 for the high probability trend trade is so precise that it'll have you using a limit order to buy or sell a pullback. And that pullback is the retracement, the fight that the small crowd creates. And you are going to buy or sell that pullback at an area. We're going to use fibs, mid bands, or yellow 1-to-1s inside of triggers. And guys, areas inside of triggers is the most important phrase you could ever type on your chart as a brand new user. Because triggers will define where the market is most likely to retrace, where it's most likely to return. And if you look at the large chart again, one thing that you'll notice is that price seems to pull away from large triggers, and then it always seems to return. And then it pulls away, and it always seems to return. So when it gets out of sorts, it loves to return to the large triggers. When it gets out of sorts, it loves to return to the large triggers. We're going to take advantage of this because large triggers on the large chart or on the small chart, where's my small chart, are going to define where the retracement is most likely to go, where the small crowd's fight is most likely to go. So price may return to the large triggers on both charts, whether it's the 5-1, which are smooth, or the 13-2, which have been superimposed on your small chart. They look like they have steps. From the highest point to the lowest point defines right where the market is most likely to retrace. And the wider apart they are, the bigger that range becomes, a little less accuracy is available. So I encourage new users to look for what we call favorable large triggers. And favorable large triggers mean that the large triggers native to the 5-1, where the 5-1 price may return, and the synthetic triggers, which are from the 13-2, which is where the 13-2 price may return. When they are one on top of the other on your entry chart, that 5-1 chart, riding along like two snakes riding piggyback, it creates the smallest possible point for a retracement, defining where that pullback is likely to go. And then when you put areas inside of favorable large triggers, this is going to give you the least amount of risk and the highest accuracy that you could ever hope for, looking for the high probability trend trade. This isn't the only entry, guys. You'll see this one a lot. This is your best entry, and my first hour is dedicated to giving you the highest chance of success. So let's go through. How do we define it? How do we figure out where the market is most likely to continue? Once the rules are met on the large chart, it's important that that's a part of the equation. Once the rules are met on the large chart, when I have the advantage of momentum, when my path is clear, what I'm going to do is I'm going to wait for a reversal bar on the smaller, faster chart. I'm going to see my triggers going up. I'm going to see fibs. I'm going to see mid bands. I'm going to see yellow 1-to-1s. But everything is going up, and my rules say that I'm going to buy or sell a pullback. And that pullback begins with a reversal bar. This is a down bar after all of the up bars. With all that momentum on the large chart, with that clear path on the large chart, I'm literally going to wait on a smaller, faster chart for the market to start down. The reversal bar is not, repeat, the reversal bar is not your entry. The reversal bar is where you're going to get work done. And you're going to look for those trigger lines from the top line to the bottom line. Large and synthetic, doesn't matter which is above which. This white box defines where the market is most likely to retrace, where those price bars are most likely to go down. Is everybody okay with that? Pretty cool, right? You can look at a small chart and say, hey, this is where the price is likely to go. And that's pretty nice to have that range, and a lot of traders would kill to have that accuracy. But we take it one step further. Once we define where the retracement is most likely to happen, you're going to define where it's most likely to bounce and continue with the trend, where the small crowd is most likely to fail. And those are the areas, fibs, midbands, and yellow 1-to-1s, inside of triggers. And it's important that you remember that word, inside of triggers. This 1-to-1 is not inside of triggers. It's not a part of the equation. So this tiny little box, refined down from this very big box, guys, this is where the market's most likely to continue with the trend, with the momentum, with the clear path. So your job is to study this enough to develop the courage to activate a limit order, to right-click on your chart and say, you know what? If the small crowd can push down 2 ticks above that highest point of support, I'm going to enter the market. I'm going to take that long trade because of the advantages. And the cool thing is if they do, you are in a long trade. You're in a position. And not only are you long, right, but you're long because you have the advantage of a market which told you that the odds are favorable that it will continue up with the trend. You are in a long trade with the advantage of a clear path. There is absolutely nothing on your large chart that suggests that a bounce is imminent. And you're in a long trade having entered exactly where the market is most likely to continue with the trend, precisely where the small crowd is most likely to fail. And guys, this is your high probability trend trade entry. And this is all we've talked about for 40 minutes, is being able to identify using 3 simple rules on only 2 charts where the market is most likely to continue. So we're going to go through it again. Reversal bar begins the pullback. Define where the retracement is most likely to go by using large and synthetic triggers. And then create a window of opportunity where the market is most likely to bounce and continue in the direction of the trend. From the highest point of support to the lowest point of support inside of triggers, this blue box represents where the continuation is most likely to occur. But because we have momentum and clear path on the large chart, your job is to activate a limit order 2 ticks above that highest point of support. Trigger lines, show me where the market may retrace. Areas inside of triggers, show me where it's most likely to bounce. And guys, the reality is you don't know which area it may bounce off of, but because of the large chart advantages, you are in at the top of that window. And any line on the wrong side of the triggers, guys, anything below the triggers, beyond the retracement zone, beyond the bounce point, guys, this is the wrong side. This is outside of that window. This is not an entry. Once you get below those triggers, there is no telling if or where that market is likely to stop. In a downtrend, smalls below the large on the large chart, nothing in the way, waiting for the reversal bar. At the time of the reversal bar, you identify your triggers. This is where those bars may return. You identify your area inside of triggers. This is where it's most likely to bounce. Your limit order goes 2 ticks below that area, and then you've done everything you can do. They're either going to get you or they're not. They didn't get you here, but they came back for you here. Any line on the wrong side of the triggers is where the market should not go. Guys, your advantage is gone. You don't know if or where it's going to stop once you get to the wrong side of the triggers. So by defining where the market is most likely to continue, by having that precision, thanks Nexgen, you can also define where the market is most likely or where the market should not go. And that should not go point is where your initial stop will be in the high probability trend trade. Your initial stop will be 4 to 5 ticks above all the trigger lines, beyond that window of opportunity. And if the small crowd has it in them to get up to that point, you will take a loser. And I know that makes a lot of you shudder. Nobody wants to take losers, guys. It's a part of it. It's a part of trading. It's a normal part of the positive equity curve. And I don't know one trader in my 5.5 years of experience that trades without losers. The key is to take the correct losers, to take the losers that had every advantage, that are a part of the pattern that has been proven to win more than it loses. And your initial stop isn't a big loss typically. But more often than not, you're going to get a reversal bar in the direction of your trend and the direction of your trade. There's a lot of people that lie about it. And once you get that reversal bar, you can reduce your risk 2 ticks. It redefines where the market should not go. And your new risk can be 2 ticks above the reversal bar or below the reversal bar. And it's not uncommon to see you in this class, to see Nexgen users take the perfect entry, get the reversal bar, minimize their risk, and maybe every now and then the small crowd finds it in themselves to push down where the market shouldn't go and take you out of that position. And it will happen. But let me show you, I've got a picture. And I made it into a study picture because by defining where the market is most likely to continue, you know where it shouldn't go. And once you take that great entry and get a reversal bar, guys, this is literally 4 ticks of risk. A tick is the smallest increment the market can ever move. 4 ticks of risk on the S&P is $50 risk on this trade. And it went down. And eventually, it didn't work out. And that's okay. That happens sometimes. But virtually just insignificant losses. It's pretty cool that you can do that. But you've got to study it. You've got to learn these patterns, guys. We've broken down the rules. Now you've got to piece them together to take a trade. You've got to be able to recognize momentum because then you have a market where the odds are favorable. Sorry about that. Where the odds are favorable for it to continue in the direction of the trend. You have to have either a clear path or at least that potential to break because of momentum. And once you have this look on the large chart, that's when you go to the small chart. Let's do a picture. I'm in a picture mood today. You're going to make your decision to take a trade somewhere up here. The market's going to be all the way up here, and you're going to be like, oh my gosh, I missed it. And then the reversal bar prints, and you're like, okay, maybe there's hope. And you're going to define your window of opportunity, and you're going to say, all right, come get me. And then they're going to come down and they're going to dance a little bit on the way down. And you're going to be like, oh my gosh, they're going without me. And they're like, no, we're not going without you. We just wanted to scare the other people. We're coming right to your support inside of favorable large triggers. And then we're going up with momentum and path. And guys, what's a very real thing is until price reaches the area, it's a target. And that 8 ticks to your target turns into 38 ticks. That $80 turns into $380 through buying the area inside of favorable large triggers. And that's what we're doing. So anytime you go back and study and you see one of those tails on the large chart, back it up. And there's my small triggers. There's my large triggers. They're split. But it pulled right back to the large triggers, right to the areas below it, and that's where it started to head down with the potential to break. And you can actually go back and do that, and you can begin to study this look and develop a little trust in it, and let's see if we can find one. Termination, odds favorable. That's not the best look. Maybe the S&P has one. Remember, 90% of your day, right? 90% of your day. My goodness, I've got a lot of stuff open. There we go. So let's see if we can find one. That looks like a pretty good one. Odds favorable, nothing in the way, coming from a termination. What's it look like on a smaller, faster chart? Whoops. Could retrace and bounce here. Could retrace there. Area, that's precisely where it came from, and off it went. That one is right before the momentum is gone. We'll go back and take a look. Just didn't make it. Didn't make it to the area, guys, but the patterns are good. The patterns are true. You've just got to find when your rules are met. Right back to the mid-band, right there at the trigger. So you're going to want to study. And you're going to want to practice, and you're going to commit these looks to memory so that you can get to where you want to be ASAP, guys. And the fastest way to do that isn't always taking trades, new users. It's taking pictures. So this is Chart Reading 101. And Chart Reading 101 is the brainchild of me. And I did this because what I found is that a lot of times people were making mistakes on strength and weakness, and people were making mistakes on a clear path versus a termination. So I said, instead of trying to find them all together, let's find them individually. So this is designed to turn you into a chart reader. And becoming a chart reader is what turns you into a day trader. So take 25 pictures each. Strong triggers, weak triggers, clear path termination, and those entries. But here's the deal, and this is the effective part. And guys, I've been teaching people to do stuff for a long time. And writing down the correlation. Why is it? So this is kind of what your pictures need to look like. Red background means that I'm in a downtrend. The smalls are below the large, both wide in the direction space between. This is strong triggers. This is odds favorable momentum. Rule number 1 met. It doesn't talk about entries. It doesn't talk about termination conditions. It commits the look of strength to memory, and it creates a correlation between what I'm looking for in the words, how I identify it, how I describe it, what it means to me, whether or not my rule is met. And if you go through the process of doing that, 25 each strong triggers, 25 each weak triggers, and you take the time to annotate the whys, you're never going to accidentally trade with weakness. You're going to make the choice to break that rule and trade with weakness. And you're never going to, oops, I turned it into a termination condition. Every time you look at your market, your brain is going to say, did I reach an area? Where are my triggers? Oh no, it's a termination condition. And then you'll have to make the choice. You'll have to choose not to trade. So go through this. Ultimately, you'll piece all these together and create a trade. But I'm telling you, from experience, teaching people how to day trade for years, learn how to identify them individually first so that you can turn them into trades. This second one is your cheat sheet as you do it. This is the high probability trend trade checklist. And it is literally a checklist to get you into a high probability trend trade. It's everything that you need, guys. Is the market coming from a strong top or bottom? This isn't mandatory. But when a termination reverses the market and my rules are met for a high probability trend trade, guys, this is the highest probability trend trade that you could ever take. Because when a decision from a key area is so impactful to give me my rules met the other direction, it's going to be hard to stop that market. Odds favorable momentum, strength and strength. It's the same look every chart. Large chart, small chart, range chart, month chart. Weakness will always be weakness. Know the difference between the two. Commit to trading with one. Termination conditions. No triggers through, not broken, no clear path. Rule 2, not met. Don't trade into the area. Whatever you have to say to sit on your hands. Smalls above, large below, with odds favorable momentum. It has potential to break, but it's still not a clear path. Still not a high probability trend trade recipe, but there are opportunities. And only when the smalls and the large break above the area can you say to yourself, my path is clear. And then you just have to define your entry. And that word again, inside of favorable large triggers. And I'm going to let you in on a secret. The rules to make it easy say wait for a reversal bar. You'll start calling your shots somewhere over here, just hoping for the reversal bar once you understand the pattern. The second page is the actual checklist. You can print this one out, put it on your desktop. I've had people laminate it, save a tree. Hippies love it. I've never had anybody in the history of this checklist truthfully, and there's the key word, truthfully mark yes to each of these rules being met and done worse than 70 or 80% of the winners. I don't want you to trust me on that. I want you to go back and test it. I want you to go back and study it. I want you to prove to yourself that this is your highest chance of success as a brand new user, and it means that you have to learn to read your indicators. I've actually had engineers run this through the ringer over the course of like 400 days, and they ended up around 83%. God bless the engineers. So that's your cheat sheet. As you're taking pictures, make sure your pictures match what it is. And then finally, I had the pleasure of meeting a gentleman at the road races here in Austin a couple of years ago. And he's been with Nexgen a long time. And he said something to me that still rattles in my brain. And I tell new users this all the time. He told me that he struggled a little bit with the software. He struggled a little bit with his day trading until he finally wrote out a plan that defined why he was going to do what he did. And then once he had that plan was proven to win more than it lost. And all he had to do was learn how to follow his plan, and it changed his trading. And man, I still remember that conversation, and I took it to heart, and I did the same, and I encourage you guys to do it. But until you can write your own plan, I've written one for you. You can have this. This is a freebie. I'm going to give it to you. This is the KISS plan. This is the Keep It Simple Sunshine plan. This plan is a stepping stone in your learning journey. The high probability trend trade is not your only trade. It's your first trade. The high probability trend trade probably isn't your get rich trade. It's the one that allows you to see your get rich trade because it teaches you to read the indicators. So this particular plan is designed to optimize your chances of success. What does that mean? That means that this is the most effective way to take a high probability trend trade that Nexgen could ever come up with. And then through simulation, through study, through class feedback, through continuous practice, you will craft a plan. You'll write your own story, guys, and it'll be tailored to your personal goals based on your experience reading the indicators. So this one's going to teach you to do that. Optimize your chances of success. And your simple plan for consistency, don't fight the large chart. Let me show you why. Don't fight the large chart. Don't trade into termination conditions. They're likely to stop the market. It takes away your advantage. Don't fight strong triggers. The market, the odds are favorable for it to continue down. Why would you go up? Hell, don't fight the trend. That's what the large crowd wants to have happen. So don't fight the large chart. And then guys, just define your entry. Focus on entries. Success in trading is very rarely about the desire to win, but more so the flawless execution of the process that has been proven to win more than it loses. So define your entry. Learn how to get into the market where the market is most likely to continue. This is going to give you the least amount of risk and the highest profit potential. And then once you can define your entries, guys, once you can go through and you can pinpoint where the market is most likely to continue, and you have the courage to activate that limit order, and you enter a position with all of those advantages, you have to manage it. And this is the second piece of the puzzle. And this is the one that makes most of you pucker up. So your management in the KISS plan, it's based on 2 contracts. You're going to enter the market with 2 contracts. And then eventually you will create your own management plan that revolves around how you read your indicators and your own personal goals. But in the beginning, if you allow management to be every bit as mechanical as your entry, if you allow management to be if-then, the same way your entry is, it takes a lot of the stress, a lot of the emotion out of the management. So the KISS plan management is designed to do 2 things. It's designed to help you understand where your stops belong. As a brand new user, it gives you a very clear spot for stop placement. And the second thing is it teaches you how to get paid, because that's the goal of trading, guys. And the one thing that you'll realize is that base hits pay bills. That's one of my favorite phrases. Base hits pay bills. Every trade doesn't have to be a $1,000 trade. Every trade doesn't have to be a $500 trade. So the KISS plan teaches you to get paid. And it's 100% dependent on your ability to enter the market where the market is most likely to continue. And once you get in at that area inside of favorable large triggers, your initial stop is 4 to 5 ticks below the lowest trigger line where the market should not go. And then you're done. That's it. Sit on your hands. You are either going to get stopped out 20 to 30% of the time in the high probability trend trade. That's going to be your result, guys. It's okay. Losses are a normal part of a positive equity curve. But if you're taking the correct losses, you had a better chance of winning than losing. And more often than not, if that stop doesn't get hit, you're going to see that reversal bar in the direction of your trade. You're going to see that confirmation bar confirming that now the market is going up with odds favorable momentum, that now the market is going up with a clear path, and it's going up right from the area inside of favorable large triggers. So your first stop movement, if the market gives me a reversal bar, then my new stop is 2 ticks below that reversal bar. And then once again, you are thrust in a position of doing absolutely nothing. Let these trades play out on simulator as a new user. Don't try to manipulate the plan. Just try to follow it, build some trust. Your first target is only $100 away from that great entry. And if they don't get that tiny little stop and they go to that first target, that's $100. One contract comes off, it goes into your account, it creates confidence. Your sweaty palms dry up, and guys, you're gonna move your stop to break even. Not only are you getting paid, which relaxes the heart a lot, but now you have absolutely no risk on this trade. And you're doing this not because it's the best stop. You'll create a plan tailored to your personal goals based on your ability reading the indicators, because this no threat of a loss stop gives you the courage to hold for your second target. And your second target, KISS planners, is only $200 away from that beautiful entry. That's it. That's 16 ticks in the S&P. It's only 20 ticks away in crude oil. And guys, if it hits that second contract or that second target, that's it. You're out of the trade. You're done. There's nothing else to do. You're no longer in the market, but you're out of the market with a $300 profit. And this is I think one of the most important things I'm going to give you today is the daily goal sheet. $300 a day is $75,000 a year in your trading account. If you stumble into one extra break-even trade every day, $400 a day puts you in six figures based on 252 trading days a year. It's not about catching every move. It's not about being the first one in. It's not about being the last person out. It's about being focused on following your rules and executing the plan, because it has been proven to win more than it loses. So there's two things that you have to know when it's time to jump off the simulator. And there's two things you have to trust. You have to know why you will enter a trade, and your entry rules should be based on a pattern that has been proven to win more than it loses. Verified by you, not believed just because I said it. You're going to see that it works. I guarantee the people in this room are going to show you some high probability trend trades. But you also have to know why you're going to exit, because management is where emotion kicks in. Entries, there's very little emotion with entries because you can't wait to get in the market. And then once you're in, that's when your brain tells you you have something to lose. So you have to know why you're going to exit. And your exit conditions, guys, are nothing more than your advantage going away. So if I enter the market where it's most likely to continue, my advantage goes away if it pushes to that point where the market shouldn't go. I have to exit. If the market's going up and I haven't hit my targets and 3 divergences print, that's a loss of my advantages. That's an exit. So you've got to know the two. You've got to believe in the patterns and trust them. And you've got to know what it looks like when your advantages are gone so you can manage effectively. And your rules are going to help remove the emotion. You'll never know what's going to happen, but you will recognize the patterns that give you an idea of what is most likely to happen. So I tell you guys every morning, I'll give you everything that you need to be successful with the software. Everything in this room. So we're going to do it again. Gift giving time, guys. There's my spreadsheet one more time. That is your trade journal. Look at that. That is your trade journal. That is your basic rules learning tool. That is the client trades, showing you the perfect entry for longs and shorts. Almost 400 pictures of you guys using the software. Amazing. Me stealing it from you and creating a study guide for new users. There's some ideas on the NASDAQ. I'm not afraid to talk about the NASDAQ, but the NASDAQ is fast, and it's probably too fast for the average new user. Very basic management plan, as we just discussed, and then some ideas on when you can start holding for bigger moves. And the one thing is you're going to see patterns, guys. As you go through and take these pictures and learn how to read your indicators, you're going to see these patterns. I've taken a lot of pictures of patterns there. You've got to go through and build your trading plan through study, through simulation, through class feedback. You need to build your plan, and the easiest way to do that is to know what you've done right or wrong. So we've learned the rules, we've broken them down, you know how to study them, you know where to study them, you can simulate, practice, break all the eggs, take all the pictures, and for 15 hours every week, you have a live body in front of you, and my sole purpose in this world is to tell you what you're doing right and wrong, and to help you overcome challenges, and really to celebrate victories. I do love to celebrate victories. And a lot of times you guys will think you screwed up and show me the picture. I'll be like, that's perfect. Great job. Do it every time. It's just a cost of doing business. We simplified. You have a trading plan. You know exactly why to get in, exactly why to get out. So I'm going to drop in the room right now. This is a zip file. Download it, extract it to a trading folder, put it on your desktop. I don't care what you do with it. But inside of that zip file is everything that you need. You have the spreadsheet. The zip file has the chart reading 101 in there. So now you know how to study it. It has the daily goals in there, so you know you don't have to hit a grand slam every time you come up to bat. It has the exit conditions for 4 different trades, but we're going to keep you focused on one trade till you're good at it. It has my PowerPoint with every picture that I use. It has the high probability trend trade checklist with the cheat pictures as well as the one you can print out and put on your desktop. It has the KISS plan, and the KISS plan gets you focused on the high probability trend trade, and then it gives you rules for that 50-50 trade, guys. And I'm going to tell you, if you can't identify a strong top or bottom, you're going to struggle with the trade. If you can't identify odds favorable momentum, you're going to struggle with the trade. If you don't know that it takes momentum to define a 50-50, you're going to struggle with the trade. And if you can't identify divergence, you're going to struggle with the trade. So let those lessons from the high probability trend trade take you where you need to be. And then finally, there's one more in there, and this is a new one that I put together. And I'm kind of proud of this one. I was working with my nephew, Chris Novak, and I was like, man, we got to simplify. We got to make this so that if somebody walks up to Nexgen and doesn't have 1 second to be in my classroom, how are they going to find the high probability trend trade? They're going to do it by understanding the rules and where to find them. They're going to do it by understanding the indicators, what the rules mean to you, how to identify them, what the rule number 2 is, how to identify what they could be, and defining it, how to pick your entries, a step-by-step going through, and how to study. Guys, this is everything that you need to be able to take a high probability trend trade. The only thing you need to do is practice and ask for feedback. Practice and ask for feedback. Make a mistake, learn how to fix it. That's how we get to where we want to be. That's the second half. We're going to look at your charts that have been annotated, showing me what you did, why you did it, where you did it. And everything that you did right, we're going to high five. Yes, that is momentum, without a doubt. There's the look, the separation. I absolutely love it. And no, that was not a clear path. You said that it was, but I want you to see how the large triggers haven't quite broken above. This is that potential to break look. And you're going to show me your entry. And you're going to say, all right, I got in right at the area inside of favorable large triggers. And I chickened out right here because I noticed that I was up $500 and I didn't want to give any of it back, so I just exited. And we'll talk about how you can hold that trade to the next area when all the advantages are in place. And every opportunity, every time you drop something in the room, it will be a private session. And I'm a huge fan of pictures. I'm going to share one more thing. Someone in this room tells me that I suck at leaving, and it's true, I do. I made this one. I'll drop it in the room. The pictures you can take, and you can take all the pictures in the world. I firmly believe that more is better. In every trade that I take, I typically take 3 to 5 pictures, depending on the speed of the trade. I always take a pre-trade. When I set my limit order, I take a picture. Let me go back. I'll show you one from this morning. When I am pre-trade, I take a picture of where I want to enter the market because I want to come back and I want to look and make sure that I didn't break any rules. So I take that picture. Once I'm in the market, and this one went too fast to do it, I take pictures during to see if anything changed so I can work on my management plan. I also take pictures of my exits. Do they make sense? Do my exits make sense as I'm going through? Because I do. I go back and study everything that I do. And then I'll also take pictures and I'll just say I have nothing to do. So I'm taking pre-trade, during the trade, after the trade, and then I think this is one of the biggest ones for study, the no trade. hey, there was a termination condition, I didn't want to trade into it. Or the hey, there were 3 divergences, I didn't want to take this trade. I didn't have an area inside of favorable large triggers, I didn't want to take this trade. And guys, it's the after the trade, show me the entire trade. I love seeing your entries. I want to see your exits too. And the no trade. These are the 2 that you should be dropping in my room. Because what happens, so even on a no trade, right? And we're going to say, hey, this was my no trade. That's not a good example. Let me go back to the study picture. Bum, bum, bum. Here we go. I'm going to use this one because this one has some great examples. If you drop this picture in my room and you say, hey, Mark, I had momentum, I had the potential to break, there was no divergence, I had the perfect entry, and you write on your chart, I didn't take that trade because of the termination condition on the small chart. What that does for me is it lets me know that you need to be reminded that in the perfect trade, it takes 3 divergences on the small chart to keep you out of that trade. It lets me remind you that termination conditions come from the large chart. And what it really does for you is it just added a trade that you've been skipping that you should have been in. So now your trading plan just got bigger and more effective. Some people say, but Mark, the small triggers turned against me. To which I have to reply, momentum is defined on the large chart. If you don't get these small triggers turning against you, more often than not, you're not going to get down to that area inside of favorable large triggers. It's okay. So guys, the trades that keep you out, or the reasons that you stay out of a trade, take a picture and drop them in the room. Sometimes they're spot on, and we're like, yes, way to follow your rules. Sometimes you're missing beautiful trades. Sometimes you're taking confirmation when you don't need it. Sometimes you're getting in late. The more pictures you give me, the easier it becomes. So I think I put that one in the room. All right, and now my favorite part of the day, I'm going to go take a break. This is the S&P coming off of a termination condition. I have a suspicion that that flood of pictures that came in has something to do with that momentum, clear path, and pull back to a mid-band in the retracement zone. It may or may not. When I come back, we are going to your pictures. When I come back, we're going to talk about momentum path and entry on every chart, no matter what kind of trade it is. So I want you newer users to avoid being the trade police. Don't tell me that Cav traded into a termination condition. That's Cav's plan. I'm going to tell him your job is to have momentum, path, and entry, and that's what's going to set you up for success. So I'll leave you guys with the S&P. We'll see what happens. This is a setup fib question. Is my large chart missing these fibs? Are these fibs not supposed to print a large chart? Your large chart is missing fibs, Wayne. So before break, so here's one of the things. Every time I look at a large chart, this is a great picture. And let me pull this over and let me pull this over a little bit. So your large chart always has 3 time frames worth of areas on it. It should. The really fat areas, these are from a 21-3 chart. So you should have that. And what you'll notice is that they don't extend all the way to the right. The skinny ones that don't extend all the way to the right, these are your 5-1. So if you see a 5-1 fib over here that extends to the right and you don't see it on this chart, you're missing fibs. And then if it's a skinny fib that extends all the way to the right, that's native to the 13-2. So Wayne, you should have all 3. And based on this, I'm not sure. Okay, so do me a favor, take your large chart, go like this, make it small for me, and back it up on the NASDAQ. And that'll help me with an idea of whether or not you're getting your synthetics on there, or whether or not it's so far out of a range there just isn't a fib. Can you show me that real quick? And guys, for those of you that are new, I'm not a very good tech guy. but I've got a pretty good understanding of the basics, and I can help you through a lot of things. Want to drop me that picture real quick, Wayne? There we go. Thank you. And guys, this is why posting with pictures is so important. So all I see on yours is native. I don't see any synthetics. I don't see any 55 charts, which is what it would be. I don't see any 13.2 chart lines. And you clearly had a 13.2 at 527. And here at 527, there is nothing. So you're missing your synthetics, Wayne. There's a couple things that I do. The first thing I do is I just click on my chart and I'll hit F5. And what F5 does is it reloads the Ninja script. So see if that fixes it. And if you get those synthetics, if it doesn't happen, you can right click and try reloading all historical data. If that doesn't work, you can go to templates and you can reload the template. And then if that still doesn't work, you might want to just rebuild. Tick replay right there. Make sure tick replay is clicked. If tick replay isn't ticked, you won't get synthetics. This is what allows the software to pull from other time frames. So that's what I see right there. Tick replay, make sure you click it, let it reload, and see what happens. That looks like the culprit. And guys, remember, your questions don't have to be about trades. I'm here to be helpful with anything that I can be helpful with. So I'm going to take my 5 minutes. Wayne, if it works, cool. If it doesn't, jump on with Jason real quick. I did a full rebuild this morning. I downloaded new indicators, did everything brand new this morning. So if you're comparing to me and you're in the Eastern time zone, I'm probably about as solid as you can get. I'll see you guys in 5 minutes. Go stretch your legs, guys. Sorry, I lost my connection. I'm going to reload all my charts for you. Wayne, I'm glad that fixed it. That's awesome. Look at the big brains on me. So guys, here we go. I'm going to go to the very top and I'm going to start clicking on the pictures that you guys have posted. We're going to talk about them. I'm going to show this one more time because I think this is a lesson that none of us take to heart in the beginning. None of us believe that taking pictures is the way to get better. All of you that golf, if you're anything like me, I spent 2 years going to the golf course playing 18 holes, believing that I would become a better golfer by sucking on the golf course for 18 holes. Once I added into my routine, going to the driving range, hitting 200 balls in between rounds, working on specific things, making sure that my mechanics were right, my golf game began to improve. Taking pictures is your driving range. Taking pictures is your batting cages. It's your free throws without a defender. And what happens is you really just drill these looks into your brain. And Jen, it takes a while, right? I tell you to take pictures, but we all know how smart we are. We know we're going to remember everything. That's what I thought. I'm a little arrogant, a little confident. And once I started taking pictures, once I really believed that pictures were going to get me where I wanted to be, what I found is that it was true, that it was absolute truth. So I wanted to share this one more time, guys. Take those pictures, put them in the room, take 1,000,000 pictures, take pictures you don't even think you should take. And there will be something as long as you take the time to annotate them. So Cav's great at annotation. So let's see. Took trade from the second pullback on the 13-2 chart, got out for quick profit. Second trade pullback into the triggers with the mid-band inside of the triggers. Third trade got into the mid-band inside of the triggers. And not one mention of momentum or path, right? Why? Because Cav broke it. On the first one, he traded directly into resistance without the advantage of momentum and got stopped out. As the market came right back to support inside of triggers, and that's where he was able to capitalize. Or did you go short? I hope you didn't go short. Did you go short, Cav? I can't tell. I can't see the dots. And then he gets in, trade 2, just jumping in with momentum, out at a fib. And then trade 3 is a trend trade. Okay, so the first one, you didn't go long into resistance. You went short from resistance with all the triggers below. Risky trade. I'm glad that one worked out for you. And then just going with the flow. And going with the flow works. And all that momentum is exactly what carried him to his winner. And then this final one is directly into a termination condition. 6-2, 6-2, and you're missing fibs. You don't have these fibs over here, and I'm not sure why, but nice trading. I think that the best lesson out of these charts, and they're not all high probability trend trades, is that when you have momentum and path, you're going to find a way to capitalize. You're going to find something that you're comfortable with that gives you opportunity. All right, Miss Jen with the triple. You put split triggers, nothing to do for you, but there's no split trigger. Oh, different colors. Okay, took me a second. So Jen says, check it out. The larger down, the smaller up. That's not momentum. I can stop looking for my trade already. And if you went further into it, you could also say no momentum, no clear path. This is a great picture, guys. This is one of those pictures that keeps you out of trouble. This is one of those pictures that reminds you that you have a very specific look that creates a very specific advantage. And if it's not there, it's okay to do nothing. And Jen, that's great. More split triggers, just have to wait. Once again, larger down, smaller up. We're coming from a termination, but we're going right into a termination. Just not Jen's best look. So once again, Jen says, okay, Instead of taking a trade, how about I take a picture and talk about why my advantages aren't present? And then finally, ridiculous split triggers. Not a great look for me, even with a confirmation bar reversal. Why? Because the market could go all the way down here. It could go from up there. Guys, this is not the advantage that Jen's looking for. So I'll tell you what, I don't know if you did that on purpose, Jen, but the fact that I talked about how taking pictures when your rules aren't met will make you a better trader, this is it. This is 3 times Jen doesn't give away money to a market without advantages. I love it. And it was funny because on break, I walked out and I walked up to my Jen and she goes, man, the market's crap. Her exact words. And I was like, is it crap because you're losing? She goes, no, it's crap because I can't get my rules met. And I was like, all right, good job. It is FOMC day, Wayne. And it is behaving just like an FOMC day. What did crude oil do after inventories? Did they break out? Not so much. They're still stuck in a range. Still stuck in a range. All right, let's see what's next. Bum, 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 bum. Not a lot of pictures from you guys today. So I'm going to talk as much as I can on each picture. All right, we have Cav. Cav says, check it out, Mark. Strong triggers below the red fib. Took a pullback. You didn't take a pullback to the yellow 1-to-1s. It didn't even come close. But it did go right to resistance inside of triggers and made for a pretty awesome trade. And once again, Cav, I just have to point out, you appear to be missing fibs. You've got fibs printing on your 13.2 that don't seem to be showing up on your 34.5. You're getting your 21 fibs. You've even got 5.1 fibs here. 47. I'm not sure where these are coming from, but they're not showing up here. So good job recognizing them. Nice trade. Another great looking short. That's your pattern. That is the pattern. All right, Jeffrey Dean. So let's see. We were talking about being inside of triggers to set a limit order. I see a mid-band, synthetics, blue Fibonacci support, and red small and green triggers almost going in different directions. Is it better to be completely inside of triggers? This trade did go to 73.18 to 73.60. My question, is this a bad entry even though it did take off? So Jeffrey's asking, Mark, is this a good trade even though my rules weren't met? Right, Jeffrey? That's what you're asking. It was a winner. Is this one of those winners that I should take every time because it produces an advantage? So let's look at it. Larger down, right? But smaller up. So this is where I always go. Do I have momentum? And the answer is no, I don't. And then I ask myself, do I have a clear path? Well, my smalls haven't even made it above support yet. My large are below 2 areas of support. So I have to answer no to this one as well, Jeffrey. So as of now, without ever looking at a small chart, I'm already 66% in the hole. No large chart advantages. And this is why I tell you guys, let the large chart lead the way and let it tell you. And then even here, your large triggers are up, but your synthetics are down. There's no agreement. You do have areas. So really, you're taking a shot. You're saying, oh, shoot, I hope it goes up. And it did. And it said, Jeffrey, we're going to give you this trade. We're going to give you this one because we want you to believe that this is when you should enter the market. We want you to believe that this is when you can predict what's going to happen next. And then once you put your live money on it, we're going to beat the ever-loving crap out of you because the reality is that's not the look. Does that make sense? I love the picture. And guys, you guys getting lucky makes me happy. I would always rather that you win a trade, but I will never hesitate to tell you that it's not repeatable. And these short-term victories feel good, but they typically lead to long-term failure. is what happens. So, no, that's great, man. Every time you guys think about something, you should drop it in the room and let's have this discussion. And I'll tell you, there's going to be times where you don't like my answer. And one of my favorite phrases in the room is "but it won," right? Because the human brain remembers the moment. It remembers the moment. It's, yeah, I robbed the bank, but I didn't get caught. So it's probably okay to rob banks. And you ever seen the bumper sticker, "but did you die," right? But did you die? Well, there was a better chance. Just because you didn't doesn't mean the next time you won't. So great picture, Jeffrey. Awesome picture. Great annotation, talking about it, what you saw. If you always go back to those three things, momentum, path, and entry, you'll always know whether or not you should have been in that trade. Then Jen says, strong bottom. Thank you. I work out. Everything's going up. Trade 1 wasn't perfect. It had split triggers. And she says everything's green. Everything's up. The momentum is great. The potential to break is awesome. But since the market, Jen, I'm going to put words in your mouth because we're just going to add lessons in here today. Jen said this retracement could go here, or this retracement could go here. And Jen knows that she doesn't know. I don't know which one it's going to be. So let me show you the brilliance. Jen says, let me force the market to go in the direction of my trade. Let me force a confirmation bar because my entry isn't perfect. Because then at least my stop goes 2 ticks behind it. Whoops, my pause goes 2 ticks behind it. My stop goes 2 ticks below that reversal bar instead of 500 down here below the synthetics. That confirmation bar is good, and you'll notice that it never goes below that 2 ticks. She hits profits twice and exits. She says, okay, awesome. Profits on one, out break even on the second, and then it just sets up again. And because of the split trigger, she waits for confirmation again. And she makes it all the way up to the fib. And this is great. So I think the crux of the lesson here is that if synthetic triggers define the retracement potential, if synthetic triggers tell you where your stop has to be, and your triggers aren't perfect, force the market to give you what you want. And Jen, you did it expertly. And there's a cost associated, right? There's a cost associated with confirmation. But if you never get it and it goes down here, you don't take the loser either. I think you handled those perfectly. Nicely done. Cav, let's see what you're doing. Weak bottom. Price coming from a divergence doesn't mean anything to me. It's just a loss of momentum. You place a limit order inside of the large trigger with a mid-band below the red fib. Small triggers stayed above the 1-to-1s. Limit order on the second pullback. So you said even though there's 2 correction points, I'm willing to take a shot with this look on the large chart. That's all it is. Cav said I've got weak triggers and divergence prints. There's a good chance it's going to make it to that mid-band area. And sure enough, he gets in and he rides it right to the trouble. Right to those 1-to-1s, right in the exact same range. He says, all right, let's see if this momentum will push it to trouble. And it did. And it came from an area right inside of those triggers. And Cav, great trading. And it really is. It's fun to watch you guys come up with your plans. Jen says, check it out, Mark. I'm assuming the large chart rules are met. No divergence. Pull back to the area inside, in between the correction zone, understanding that the stop goes up here. It's a good look at an entry. And sure enough, it went up to those other ones, didn't it? So here's the whole picture. You know what's funny, Jen? And you're going to hate this observation. It's not perfect, I'm going to force confirmation. It's not perfect, I'm going to force confirmation. Damn it, I'm bored. To hell with confirmation. That's what happens when the market isn't giving you what you want, guys. And Jen, this is a beautiful look. 50-50, no divergence from a strong top, right back to the area. And your stop was right where it needed to be. So, I mean, you executed this beautifully. You really did. And it's just comical that the third trade you chose not to wait. And what's funny is the confirmation bar is the exact same price as your entry with less risk. And then there's profits. Nicely done. But it's okay, but that's normal. And guys, I don't point these things out to try to shame you or anything. This is what happens in a slow market. Guys, the longer your rules aren't met, the more likely you are to fabricate. The more likely you are to break what you know is right. Yeah, no, I love it, Jen. I really do. And I think your transparency is one of the big reasons that you're finding success. And I also think in transparency is you've shown me the break evens, right? And you've shown me the winner and the break even and the winner and the winner, but you're down $275. So the math doesn't add up. This is either a different account or you're not showing losers. Different account, right on. But I notice those things too. It's my job to notice those things. I love winners, guys, but we all get smarter. We get smarter on the losers. I know you would, Jen. That was a warning shot for everyone else. If all you show me is the winners, guys, you're robbing yourself of the good information. All right. Morgan has a strong bottom. Good job, Morgan. And it creates odds favorable momentum. And it gives the area the potential to break. So I'm going to read this. I believe there was a lesson about the small trigs being a full bar away from the mid band, but I couldn't remember it, so I took the reversal bar for entry. So you're absolutely right, Morgan. And this is the NASDAQ. Ladies and gentlemen, the NASDAQ is a different animal. So Morgan, if you reach your entry point, your area inside of triggers, and the small triggers are a full bar away, I'll enter at the area. If I'm trend trading the NASDAQ, I'll enter at the area because it's likely to snap back to them. This is a 13.2 and it gives me the least amount of risk. Trading directly into them, they could have come back and gotten you. That's okay. But I love it. You took the trend trade. You waited for confirmation. You got out, not at trouble, but then you second guessed it when it started coming back down. So you took your first profit there. And then there's your second. Nicely done. Great trade, dude. But this is the one. This is the look. Let's do that. Let's add this one to the NASDAQ spreadsheet. Hey, Cav, take care. Great trading today. So we're going to get lessons on everything. On the NQ, if large chart rules are met and the pullback to area happens, look at the small triggers. I guess we have to make this bigger, huh? If they are full bar away, above reversal bar marker, enter at the area and manage if need be at the triggers. Does that make sense? So that's a pretty good one. That's a great picture. I'm stealing it, by the way. I'm going to steal it, and I'm going to go to the client trades. and I'm going to put it in there, and we'll call it Morgan's NASDAQ entry lesson for the world. Give you a little credit for it. Great picture, dude. And that's it right there. But you knew the lesson, you weren't sure on the execution yet. So a little confirmation. Hey, JRK Han. What does question mean? And ask all the questions you want. Welcome to the room. So while you're typing, I'm gonna give the disclaimer. Every day when I teach on crude oil, and I teach how to check the news for sure. Every morning I go to forexfactory.com/calendar. There's the link for you right in the room. And every day I'm looking for high impact red boxes and medium impact news. So today when we took this one, and I'm going to show you something that's pretty cool, is it doesn't matter what the news is. But I know that at 2 p.m. I've got high impact news. I've got news that could make the market change direction. I've got news that could make it spike. I've got news that can pull me out of a position. And since it's FOMC, could slip me thousands of dollars. So every morning I check news, and anytime I see one of those news releases, anytime I see a red or an orange box, I personally make the decision to not be in the market 2 or 3, 4 minutes before it happens. And I refuse to enter a position until the market has settled down back to a pace where I feel comfortable that I can enter, that I can control my stop placement and my targets and whatnot. So great question. Thank you for that. Ask all the questions. It's great to have you in the room. I've actually got it saved into my favorites. That's the first thing I do every morning. And every day when we start class, that's the first thing that we look at as a classroom as well. And yeah, Wayne was saying you can filter it just for USD, and that takes a lot of the noise out of it. And if you're like me, if your computer is in the Eastern time zone, but you're in Central, make sure you do the math if you're away from your computer. All right, Cav says odds favorable, clear path, entry at support, out at the third divergence. I don't make recommendations, JR, because I don't give trading advice. But what I can say is that in my own personal trading plan, I choose to not be in a position 3 to 4 minutes before news releases. How is that for giving you my 2 cents without telling you what to do? I choose to not be in a position 3 to 4 minutes before a news release, and I will sit on my hands until the market goes back to a tradable pace for me. That's my plan. That's written into my trading plan. Awesome. Good questions. Great questions. And guys, there it is again. Momentum and path. Momentum and path. And then look, 3 divergences in the same price range. Kills it. Cav left up $4,600. That's a pretty good day. Cav has asked a lot of questions, spent a lot of time, and it's worked out. All right, Wayne. Whoop, we saw that. Cav. Once again, everything says up, and Cav says, I'm trading directly into a termination condition. Rules not met. Seen this look many times. Took a limit order inside of the triggers and wrote it up. And basically, rules not met says, man, I sure hope it goes up. And I don't know if his whole day was on sim, but guys, one of the things about simulator is it's going to give you testicular fortitude or ovarian fortitude, if that's where you're at with the chromosomes. But trading directly into Fibonacci resistance. Trading directly into Fibonacci resistance without momentum. Guys, there's nothing on the large chart that says take this entry. he let a good look here get him into it. And anytime I see this, anytime I see this, I like to go back to pictures, like this. Because I have a picture for everything. And this is one of the things that I try to really instill in you guys. This is one of the things that I try to really just beat that dead horse. This was crude oil. This was before Thanksgiving, I think. But there were 36 times that the rules for a termination condition turned the market and would have created a loser. There were 6 times where the area actually broke. 36 times loser, 6 times you get away with it. So remember that day trading isn't about the one time you get away with it. It's about the 10 times that they punish you for breaking a rule that you know takes away your advantages. This is a pretty good one, isn't it? This was the day before Thanksgiving. I'll share it with you. But I remember stuff like this, guys. When I teach rule number 2, and rule number 2 is the most broken rule, Exhibit A. Let me give you a little insight on 5 years of working with people. Is I see people following rules to the letter and do well with it, and they begin to feel a little invincible. And they start breaking rules, and it's the craziest thing because the market allows you to get away with breaking your rules 3 or 4 times in a row to the point to where your brain says, well, maybe I don't need to worry about termination conditions. The 30-day rule. Marty knows it. I'll tell the story. And then you start doing it as a part of your plan, and you can't figure out why you just lost 60 grand. And that's based on a true story. So the 30-day rule, guys, I'm gonna share that with you. Thank you, Marty. What is the 30-day rule? So for those of you that don't know me, in a previous life, I taught managers how to manage. I was the guy that that created checklists, systems and routines. That was when the CEO and the vice president was talking about me, the one thing that he always talked about was Novak is on systems and routines. He creates plans. So for this restaurant that I was working for, they would send me managers from all over the country when they were opening new restaurants. And they're like, we need Mark to train them because Mark creates quality managers. And that's cool. That felt good. Maybe I'm bragging a little bit. But the one thing that I did is every time you came to my restaurant, we sat down and I said, this is exactly what you need to do. This is exactly when you need to do it. This is where you need to be. And here's why. Here's why you have to do this. Here's why this is important to you. And if you follow this checklist, you'll never fall behind. You'll never make mistakes. And you'll be solid and you'll be great. And the people that were above me were amazed because they would always come visit around the 3rd week. And my new managers were using this checklist, this KISS plan that I'd give them. And they were brilliant and they were amazing. And right around the 4th week, guys, right around 30 days, and that's what Marty was referencing to, the 30-day rule, people tend to get the 30-day stupid. And I hate to use that word stupid, but that's what it was. Right around 30 days, you start believing that the rules don't apply to you. You start believing that you're better than the checklist that brought you success. And this happens with traders all the time. As a brand new user, all of you have taught enough people that you want to follow this checklist and you find a great level of success with it. And right around 30 days, that's when results tend to slip. And you've got to be able to look at your charts and ask yourself why. So the 30-day stupid, it's avoidable, but it's pretty common. And it happens. So just a little heads up for you. So when I see experienced users trading into termination conditions, I still call it out. And if it's part of your plan, cool. Don't change it. But I'm obligated to point out when that's what's happening. So termination triggers roll, makes it a strong bottom. from the strong bottom, 1036, 1039, so we're right about here. Pull back to the HVA line. HVA line trade, are rules met? That's a great question. So what do the rules say? The 500-hour pilot is the most dangerous for the same reason, Wayne? I didn't know that. That's good to know. Did you know that most motorcycle crashes happen after the second week when people buy new motorcycles, when they get cocky? That's a fact I remember. So, Wayne, what I'm going to do is I'm going to go through the HVA rules, and let's just see if they were met. Whoops. And there's only one thing that I see that may not fit the bill, Wayne. But we'll double check the rules just to make sure that I give you good information. Wow. I love it when you guys give me these facts. I don't realize these things. All right, Wayne. So looking at your picture, I'm going to take a picture of your picture as well. We'll just put that up there. Has to be a no triggers through top or bottom. Rule number 1 is met beautifully. And I think this is the most important rule, to be honest with you, is that perfect termination condition. And then it says make sure you have room to your targets, right? And you did. You had tons of room to your target. So rules 1 and 2 are great. Rule number 3 for entry says find the HVA line, and it should be positioned inside the smaller chart, smaller large triggers. And Wayne, that's the only challenge that I see with this one, is when you get to the wrong side of those triggers, it decreases the likelihood of success. That's the only thing that I can see here. When you're below those triggers, because these are already turning against you, and these are below them, that's the only challenge that I see with this one. Everything else is 100% spot on. When I have this look, especially if it's outside of the lower outer band on my market flow chart, a little confirmation for me goes a long way in that scenario. Instead of just trusting the HVA line, that's where I like that confirmation. That's where I like it to start up, because then I've got risk. And on an 8 range chart, it's minimal. It's minimal. Good stuff. And you're okay with outside, because that's your pattern too, right? From that extended market, get the white bar. I like it. I mean, you gave yourself as many advantages as you could have possibly given yourself with that one. But anytime someone asks, are the rules met? I have to say all but one. Doesn't mean it wasn't a great trade. I'm just obligated to say that we were on the wrong side of the triggers there, but it's good looking, man. And I know that you've got some stuff with that outer band too, like you just said, that factors in. Andy, it's nice to have you back, man. Vacay with the daughter. So odds favorable, not a clear path, directly 50-50. You're in at 14.99, which means you were in a couple ticks below a 1-to-1, and it worked out for you. And then you let it clear and you got in and you got out of trouble. Nice. And you did the same thing down here. You had a clear path, you went in, you got out, and you went in one more time and you got stopped out, it looks like. Good stuff. Momentum, not quite a clear path. That one has a good chance of hurting you, there's no doubt about it. But good stuff, Andy. All right, Steve with the triple. I've really started to like this look, Steve. Strong bottom, it's a termination. From the termination, triggers roll, and you buy the pullback to the large triggers. Which happens to be an area right at the large triggers. Uh-oh. Man, sorry about that, guys. I didn't touch it. It just happened. I swear I didn't touch it. I watched my screen go black and everyone disappear, and I was like, uh-oh. So we'll give everyone a second to come back. Sorry about that, guys. That is what we call a technical difficulty. I appreciate your patience and your understanding. All right, so I want to... Discord headquarters is like, watch this. Hit the Oscar Foxtrot. All right, guys, so I want you to see... Oh, I was with you. So I want you to see something pretty cool here. Termination condition, small triggers roll, buy the pullback to the small triggers. In 2004, Nexgen taught a trade. This was part of the 2004 and 5 plan. Termination holds, small triggers roll, sell the pullback. So what Steve did is Steve took a trade that Nexgen's been teaching for 21 years. And that pullback to the small triggers very often looks like that, the pullback to the large triggers on the small. And look at that, Steve, 2004 trade number 2. And it still works, doesn't it, Steve? Great job. I love it. I didn't even see that annotation before I went for the other picture, but it's so even cooler that I went and got it. Great trade. And then here you have momentum. The mid-band's acting as a termination condition, absolutely, because the triggers were a full bar away. So you let it clear, or you let it bounce, it looks like. You waited for confirmation instead of just trading into it. So when it wasn't perfect, there's that language again. When the entry wasn't perfect, Steve insists on confirmation and rides that wave of momentum. Rides that wave of momentum. Great trading, Steve. And this is what we call tempting the fates, ladies and gentlemen. Support holds, they try to push up, can't make it. Support holds, they try to push up directly into a termination condition. Mr. Diego, do you see it? Directly into a termination condition. 100% into a divergence high that could potentially stop the market, and it did. And you, my friend, pulled one over on the market here. This is one of those times where I have to tell you, you got lucky. And I don't know where your exit is. Right there? Okay, right back into it. So you said with momentum, I'll take a shot, but I'm not going to hope. I'm going to get the hell out if they retest that line. So you knew what you were getting into. Oh, it just, I mean, come on. That's like background noise. That's like me listening to my wife with the vent hood on. I can't hear a damn word she says. You've got all of your typing caught up in your indicators there. So tempting the fates and taking quick profits because you know that you are. I can't yell at you. Momentum, split triggers. Entered on the reversal bar, moving so fast it slipped on the entry. So it's a 50-50 on a fib with divergence, with split triggers, and you traded right back into the trouble that you would have had to manage at. And I mean, you took it quick. Do you use the stop orders, Steve? Do you stop yourself into these? And it still slipped you that much? That's some good slippage. Welcome to the NASDAQ. I've had that. Welcome to the NASDAQ. Great trading. You're taking chances on terminations, but that's your right because you understand momentum. Nicely done. All right, let's go look at a live market. That's all the pictures. Potential to break and didn't. Potential to break. We'll see what happens. Have you guys noticed that rule number 2 has really been popular today? From termination to support to termination, and a couple opportunities in the middle. But understanding rule number 2 has paid huge dividends for a lot of you today. I definitely appreciate that. Let's see what else is going on. Once again, am I coming back? Every day, JR. Every day. So class will go from 9 to noon. I take little breaks in the middle, not just for me, but also because I believe in my heart that the longer you sit in front of a computer, especially if your rules aren't met, the more likely you are to fabricate rules, the more likely you are to take chances, the more likely you are to change your plan to get you into the market. We saw an example of that today. And it happens, and it's normal, and it's human nature. So I try to stand up and walk away for a couple minutes every hour. And I encourage you guys to do the same. Just get up and walk out of your office for 3 minutes. And then we'll meet back here and we'll finish the day strong. I'm through all of the pictures. Yep. I'm through all of the pictures, guys. So when I come back, I'm going to need you guys to ask a few questions. And JR, man, this is your opportunity. You can have a 40-minute private session when I come back. Ask me everything that's on your mind. I'll get you answers. Just start typing it in the room. I'll be back in 3 or 4 minutes, guys. All right, y'all. Here we go, last hour. And I am going to read what Jen wrote because I think it's important. When one account is down, you start changing your rules, right? I'm down $200. It'll just take one trade to get it back. It'll probably go up here. Let me take that trade. This is pretty common, guys, that feeling that it's just one trade to get you back. It's just one breaking of the rules, and if it works, then I'll be fine. And I don't know, you guys are probably more gifted than I am, but that doesn't work for me. It's never worked for me. The only way I've ever been able to be consistent is following my plan. And the further I deviate from my plan, the further I am from consistent, for sure. So yeah, chasing losses but bigger losses. Adding contracts so that you can cover your losses quicker. These are all common, guys. Everybody I know has done it. Everybody I've ever worked with has done it. So when I talk about stuff like that, I don't talk about it because I want you guys to feel bad or that I'm wagging a finger at you. I want you to realize that you are one of a million people that made that same mistake. And once you see it, once you identify it, once you accept that it is a challenge that you've created for yourself, well, then you can start to fix it. Then you have the acknowledgement, and you can start working on the path to fixing it. And you'll find that rules are everything with what we do. So much so, I love this one. There's a gentleman that's been with Nexgen for decades. And he's such a great trader that he trades for 9 months out of the year, and then he vacations home to India for 3 months a year. And he does the same trade every day, the same entry every day, the same rules every day, the same darn thing every day. And that sounds monotonous until you realize that you can make $10,000 to $20,000 every day doing the same thing when you get good at this. So because he realized that his rules were his lifeline, his rules were the reason he had success. As he was learning the software, this is back way before me, there was a chat room, and he created penalty box rules for himself. And I think this is brilliant. Because you'll all see a little bit of yourself in this. So anytime he missed a good entry, what does that mean? That means that the rules were met and he chose not to take it for some reason. Talked himself out of a trade. He had to walk away. Get up and walk away from his computer for a minute. And if he entered late, if he chose not to take the rules-based entry but instead waited for confirmation where confirmation wasn't necessary, it was 2 minutes. Getting out of a trade for no reason, and that reason is always fear, for no rules-based reason. That was 3 minutes. Moving a stop to lock in profit. Who's ever done that? Who's ever said, man, I don't want to lose, and you put your stop there and they tap it and then run in the direction of your trade, $1,000? It's 5 minutes. And these are all common, guys. Exiting late. Seeing Fibonacci resistance, watching it hit Fibonacci resistance, and just hoping that it breaks instead of getting paid at that line. That's 7 minutes. Trading against direction. Fighting the large crowd. 10 minutes out. Trying to go counter trend was a 10-minute infraction. Trading against an area. That's trading in determination conditions, the most common broken rule out there. He thought that was worth 15 minutes. Could you imagine taking a trade in determination conditions, standing up from your computer and saying, I can't go back to my computer for 15 minutes? Can you develop that level of discipline? If you can, maybe you can work just 9 months out of the year. And then finally, trading against direction and areas, the two biggest sins you could ever make as a trader. He would kick himself out of the room for the day, and that would be it. And every one of these violations is a formed opinion about what the market should do rather than what the indicators tell you it's going to do. So you guys don't have to use this. You don't have to do this. You don't have to be that rigid. Um, but I can tell you that the people that have already found the success you're looking for are that rigid with rules. And there may be something there, right? Find someone that's doing something that you want to do, that you wish you were doing. Emulate them until you can figure out how to do it on your own. I love that. What else can I give you guys? You're not asking questions. So I'm just going to make up stuff and try to sound smart. You got a thing? Let's see your... What's your thing? Here we go. So this. Did you say it in the voice I heard it in? All right. So this. All right. So thank you for a more complete thought. So this is the NASDAQ trend trade entry. When price reached your area inside the triggers, the small triggers were a full bar away. Do you remember? So part of the lesson that people don't hear, if the small triggers are a full bar away, it doesn't mean that the trade will go up. It means you have over 26 ticks of room to get to that first obstacle. Time to manage. That's it. So if I'm in right here, Morgan, and I hit those triggers, I'm probably break even. It's your area for entry. That's it. It's your area for entry. So when I get back to my area inside of favorable large triggers, where are the triggers? So this one, absolutely, get in, right? Get in at the area and be prepared to manage if the small triggers behave as resistance. And then when it comes back to the area, look at where the triggers are. That's the one that says pump the brakes and wait. Does that make sense? And guys, again, this is NASDAQ specific. This has nothing to do with crude oil or the S&P. Terminations for the win, guys. Terminations for the win. Look at this range-bound market. They're waiting for FOMC. Look at this range-bound market from termination to termination to termination. There's one in there and there. There's one. There's one. There's one. Egads and little fishes, ladies and gentlemen. Rule number 2 for the win. So why do we study termination conditions? Because more often than not, they're going to ruin your good time. Great question, Morgan. Thank you for that. I'm hesitant because the market's pretty much garbage, but let's open up a NASDAQ. Maybe we can find some real examples for that. I love trading the NASDAQ. I won't trade the NASDAQ right off the open. I had someone send me a email yesterday. I'm starting to look at the NASDAQ, and then the email that evening was, holy crap, I can't keep up. You and 99% of the world can't keep up. It's fast-paced. It is definitely fast-paced. All right, my charts aren't done calculating yet, but so far I see 3 divergences off a low down there, and then I saw potential to break, but with divergences. And Morgan, was that the one that you were just looking at? What just happened? Okay, so let's look at both sides of it and see what it does. If you don't mind, just because we got stuff to do. And guys, I had to rebuild my NASDAQ, so I don't know what half of this stuff is on here. John Novak pollutes it. Oh my gosh, Morgan, this is the perfect example. This is awesome. So check this out. So large chart is 50-50 from a strong bottom, right? Morgan says I have to look for an entry. If the triggers are a full bar away, here, so let's do this. Maybe I can just steal it from here. So let me finish the thought here. Enter at the area. There is time to manage or mange if the market reacts at the triggers. So that's the perfect look. And then right here, if the triggers are less than a full bar away, wait for the close on the other side to give you a fighting chance. I mean, Morgan, this is the perfect picture. I wish you had shown me the whole thing. Because here's your first entry. It has to be managed. And then look at this. You don't get a close on the other side, and it still continues down, right? But once you get the close on the other side with this look, off it goes. There's your NASDAQ patience piece. Take it, manage it. You're gonna either give some back or take a tiny little loser, right? Or quick profits. And then when it gets here, there's no trade. Here, there's no trade until it does this. And then it's Upsville, population U. What a great way to capitalize. Morgan, this is the perfect picture for NASDAQ entries. I don't think you knew how smart you are this morning. You are creating all the NASDAQ lessons. Don't wait, then wait. That's what we'll call that one. Don't wait, then wait. So for those of you that are trading the NASDAQ, Kurt, I have you in here. Tony the Tiger, I believe you're doing it too. Does that make sense to you? If the small triggers are a full bar away, it's all right, get in, but you're going to have to manage if it starts coming back to you. There's no reason to lose here. And then it's the patience piece. And then sure enough, I love this picture. Man, Morgan, thank you. I'll give it to you guys in there, and it's also going into the spreadsheet, and every time I update the spreadsheet, I save it. If you thought you were going to jump in here, the small triggers did it to you again. If you thought you were going to jump in here, the small triggers did it to you. How cool is that? Morgan, same thing, other direction. Don't jump in at the mid-band. The small triggers are too soon. Get in on the close on the other side. I can make some money. There's ways to tame the beast that is the NASDAQ, ladies and gentlemen. Garbage. Basura. I like it, Andy. I notice you're not doing any of the ale stuff. You're just jumping in. That's okay. You're finding your way to use it. Guys, it's all FOMC. It's all pre-FOMC day. A lot of jockeying for position right now. That's your whole day. They pushed it up, and now they're pushing it down, and they're into this giant key area. And if you step back and take a look at the big picture, It's pretty easy to see that you probably shouldn't go down, right? And that the opportunities were limited. What you guys want to talk about? Tell me what you want, what you really, really want.